Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. On a monthly basis, I attempt to help to explain what's occurring in the economy and the markets using a variety of charts and graphs in a video. I like starting with some headlines. We are seeing continued reports of companies reducing their workforce as they look to right size their business for a slowing economy or potentially a recession. Weak US retail sales, manufacturing is slowing. I'll discuss those later. I think the big news is the reopening of China from its self-inflicted COVID restrictions. And we're seeing investment dollars move from the US to the Asia region to participate in this resurgence. And then finally, the third largest economy in the world, Japan, which is very retail centric, is seeing their sales decline due to inflation that is stickier than expected. This is a great chart showing bull and bear markets since 1966. The dark blue line is the S&P 500. The blue area are the bull markets and the red area are the bear markets. The takeaway is bear markets on average last 14 months, while bull markets on average last 70 months. So, despite the fact that bear markets are much more painful for investors, they're shorter, and we recognize that they will eventually end. The key is to make sure that your investment portfolio matches the current and expected economic environment. And now's the time to reduce risk by changing your asset allocation and by moving into defensive sectors that will perform better as the economy slows or we enter in a recession. I think it's important to look at history as a way to understand where we are in our various economic cycles. This chart here looks at two asset classes, treasuries and the S&P 500, and shows us with respect to historical standards, are they expensive or are they cheap? And when we look at the dark black line, clearly we've seen a decline, a pretty dramatic decline in any year in the S&P 500. But given the fact that the current price to earnings ratio of the S&P 500 is 21.7, higher than its long-term average, that we're still expensive. And it's my belief that in order to really fully wash out, right size the economy, right size the Fed, that the equity markets need to come down to this cheap area before we can begin, a potential new bear market. Excuse me, a new bull market. Um, I've spoken in the past about a variety of indicators, leading, coincident, and lagging. In this chart from Morgan Stanley, showing the leading earnings indicator, it's in a downward trend. And to no one's surprise, I think what's important to note is that when you compare the leading earnings indicator to the actual earnings per share growth of the S&P 500, they're very highly correlated. And so we will continue to see companies, we're seeing it today, report fourth quarter earnings that are below estimates. Their growth rates are slowing, if not negative. Microsoft reported, and they're growing at 2%, which is the slowest they've grown in, I believe, history. So we're beginning to see these companies be affected by the interest rate increases that started back in March. Um, I think what's important for investors to recognize is that markets hit a bottom before the economy hits a bottom. But during that period, there is a lot of bad news, a lot of bad headlines, a lot of negative news that keeps investors out of the market. And it's important to recognize that as that market hits a bottom and there's, quote, blood in the streets, that's when we want to be investing. And many investors shy away, thinking there's further to fall. But the reality is that we've seen most of the negative news by then that's impactful, and that's the best time to invest. Again, it's during this period currently that investors should reduce their risk exposure and pivot to sectors that will perform better in a slowdown or a recession. We have seen towards the end of last year and into this year, S&P 500, especially for the fourth quarter, decline. The share weighted earnings decline. And when we look at the entire economy minus energy, which has been a strong performer, we expect those year-over-year earnings to decline some 7.3%. When we look at the growth rate of these earnings, we see that they are going to be negative. We are going to see a slowdown in corporate earnings growth rates. And again, this is what the Fed wants to occur by raising interest rates at such a rapid pace. As we look at, again, historical drawdowns from 1928 to 2002, and as you can see here, we've got a decline. This is 1928. We're the red. Again, it's my belief that we're going to have a further leg down in U.S. equities, again, because of those rapid interest rate increases, which have to this point affected the U.S. equity markets, has affected the housing market, but inflation is still declining, but is still very high due to wage pressure. And so until we see more pain in the employment sector, more unemployed, less pressure on wages, the Fed's going to keep raising rates, and inflation is still going to remain above their target rate, which is 2% currently. This is a great chart. I saw it a couple months ago, used it in a previous video. And what this tells us, the blue line are what investors tell us their feelings are for the future. So they're extremely bearish about the future. Yet the black line is their equity allocation. And their equity allocation is still very strong. It's a story of hope and complacency. We see this slight shift, but there's still a disconnect between what investors believe is going to occur and their allocation. It's my belief that this gap will have to close, and either we get phenomenal news from the economy, we get a soft landing, and we take off again into a bull market, which I believe is highly unlikely, or we have a defining capitulation moment, which we see equities drop dramatically, and investors, scared of losing everything, reduce their equity allocation at the worst time that we close this gap. I have been using NASDAQ Dorsey Wright for some time now, and I like to use it to help me track the relative strength of asset classes and individual investments. So what NASDAQ Dorsey Wright does is they compare two asset classes to determine which one is relatively stronger than the other. And they do this calculation millions of times to come up with rankings. In this chart, this type of analysis attempts to evaluate the supply and demand forces of particular asset classes and ranks those asset classes from strongest to weakest based upon relative strength. This ability to identify a leadership using relative strength and to allocate in an objective, repeatable fashion is key to consistent performance. And so you can see international equities, as I mentioned previously, are now in the number one spot. And they overtook cash most recently. Cash was in the number one spot for most of, if not all of, 2022. I like to use this, especially in the US market, with the sectors of the S&P 500 or of the sectors of the U.S. economy. Energy has been a star performer for quite some time, and so it continues to remain very strong as compared to basic materials, consumer non-cyclicals, etc. If we look at the other end of the spectrum, the weakest sectors, communication services, real estate, technology, consumer cyclical, despite those sectors having a stronger than anticipated start to the year, they're still relatively weak compared to energy and basic materials. Again, this changes over time and is a key component of understanding where the economy is going to be and where the asset allocation of the models that I manage is going to be allocated. As I mentioned previously, we have weak retail sales. The US economy, the consumer generates about 65% of GDP on an annual basis. And when we see a slowdown in retail sales, it's a concern because that's a driver or an engine of our economy. And again, I believe that we are seeing the continued effects of higher interest rates, a lower savings rate, less savings, and that translates into less things being bought. Manufacturing, which has been a very positive performer throughout the year, is seeing a slowdown as well as those interest rates crimp manufacturing. And we are seeing a pretty dramatic change in the business equipment output, the biggest drop since February of 2021. And again, that's output generated by the economy and by manufacturing that we are seeing slow down. Thank you for taking the time to watch. And if you have any questions, please let me know. Thank you.